They let you add back the depreciation, which is going to be your line down here, line 18. They let you add any HOA dues, will usually be here on 19, it'll be spelled out. And they allow you, and then you subtract your total expenses. That's the equation. It's that, I mean, that's literally what Fannie Mae allows you to use. So it's your rents received, plus taxes, plus insurance, plus mortgage interest, plus depreciation, plus HOA, minus total expenses. So the example, $12,000 a year in rental income, plus your taxes, plus your insurance, plus your mortgage interest, plus your depreciation. I made up some numbers here. The total sum was $9,350 divided by 12 gave me $779 in gross income I could use for this scenario. If your mortgage payment is $700 on that mortgage, then you have a positive cash flow of $79.16, which is great, because what does that mean? That means it offsets. That means that you just offset that payment and you can go and continue to buy. Because now you did a good job in filing your taxes. Here's something that I tell my clients. Before you go to your CPA and you file your taxes, you need to call me. We got to make sure that you're doing the right deductions. Because see, all of those add-ons, you can write off taxes, insurance, mortgage interest, but instead of doing the repairs, because you can't add back repairs, but I can't tell how many times I've seen, in the repair line, anywhere from $3,000 to $10,000, and that's not doing you anything. So my recommendation would be file it under depreciation. If your CPA will allow you to file it under depreciation, because I can add that back. I can't add back some of these other deductions. So be mindful of that when you're taking or don't take the deduction at all, and you're going to have to just bite the bullet on it. So be careful of that, because I promise you, as seasoned investors, where you are claiming income, this is going to hurt you the most. Because if you're not able to follow the first philosophy, which is if a calendar year has not passed where you don't have to claim the income yet, and you can use the 75% philosophy, this comes into play. So be careful of that. Okay. So we talked about, this is the equation, again, and I'll get you guys the slide if you guys need this. The last C is collateral. Everybody knows what that is, right? That's the property itself. That's the last piece of the puzzle in terms of qualifying a person. So you have your 4 C's, collateral being the last. That's the house. That's where the money's being leveraged, okay? This is what an underwriter sees the house looking like. When you get an appraisal done, they see this, right? This is underwriter's job to look at the property, and when they see it, they look at everything that's bad, right? This is probably what you see your house looking like, right? And this is probably what it really looks like. Okay? So we have to obviously be aware of what your property condition is, because why is that important? Because it also tells you what type of loan to do. If the property is dilapidated, you know you got to go hard money right away. There's a lot of reasons to go hard money, but that's a big one in terms of, you can't go conventional, because I'm not going to be able to finance you conventional if you got a bunch of, deferred maintenance on that property. You can't do it. So you call Chris, and Chris says, well, I can do it, and I'll give you the money to repair it, and then you'll just go to Rich and he'll refi. That's a perfect way to use hard money, other than the other things that you talked about earlier. So that's I guess, a good reason to understand what type of property you're purchasing, because that's where you're leveraging your money, is in the actual property itself. Understand the condition of it, okay? And that's the next piece, is evaluating the condition of the property for those specific reasons to verify, am I going to have to go hard money? Can I go conventional right away? Somebody asked me earlier, when is it good to just go conventional right away or hard money? Well, it just depends. If you have the capital to put down, and you have it, and the house is move-in ready, or it's going to pass, pass inspection or appraisal, going conventional, in my opinion, would be the best way to go. Because then you don't have to pay 2 sets of closing costs. You don't have to go through that process if you have the capital. If the capital is limited and you aspire to want to buy more properties with the capital that you do have, well then, as Chris showed earlier, You can buy it with less out of pocket going hard money, but be prepared that you're going to have two sets of closing costs. You're going to have your hard money, and you're going to have then your conventional. So you have to really understand where that lies and what that looks like. So evaluating the condition is key. Do your research. Do your research of the market area, what the market rents are going for. Really understand that. And that's what the Keller Williams team here does very well. Some of you guys are lifestyle members, and the Lifestyle Realty Group does a really good job of that as well. You know, evaluating the condition, evaluating market rents, making sure that you're getting a good return on your investment. Obviously, all that is key in determining the collateral, which is the property. Return on investment. Chris showed you guys a calculation on how that works on his side. I'm going to show you a calculation on how it works on our side in determining whether or not you're getting a good return on your investment for the property that you're going to purchase. You want to look at your market rents. You want to look at all of these things that are going to factor into the return on investment. So here's a return on investment calculation in terms of how you can come up with it. It's probably similar in nature. But basically, you're going to take your monthly rent minus your total monthly payment equals your cash flow. Right? That's what you're going to be cash flow. The cash flow times 12 months is going to equal your total annual cash flow, what you're making for the year. And then you take that total annual cash flow and you divide it by what you paid for the house out of pocket. And that's going to give you your return on investment calculation in terms of what you're truly yielding annually from this investment. And that's something that you can do really quick to say, I'm getting a pretty darn good deal here. So the example down here, you buy $150,000 purchase price property, 20% down, plus your prepaid, which is your escrows, your lender costs, your title fees. Let's say you got to bring $35,000 to the table when it's all said and done. Now you got a $130,000 loan amount, 30-year term, payment somewhere around $700 a month for principal and interest. Okay, give or take. Your taxes and insurance are about $400 with HOA. Your total PITI is $1,100. That's what your mortgage payment is going to be. Your monthly rents are $1,650. That means you have a cash flow of $550 a month. Take that $550 times it by 12. You got an annual cash flow of $6,600. Take the $6,600 and you divide it by your initial investment, and then you get your return on your investment. You get a 19% ROI. Yes?
That's for the first year. Second year, it's astronomical.
Agreed. Yeah. Agreed. Agreed. So this is just a quick calculation to make sure that you're getting a good deal when you're buying it. You know, this is, I mean, where can you get these types of returns other than investment property, the passive income game? I mean, really, it doesn't make any sense if you're not doing it. If you have the capital and you want to know where to put your money, put it in real estate. Put it in real estate, because you're going to get these types of returns. So, for percentage in terms of return, I would say that, I guess that's who you ask, but I would say anything over 10% is a good return on your investment. I would say anything over 15%, you should buy. And anything over 20%, it goes without being said, right? But I would say anything over 10% is a good return. It's a positive return. Now, most of the deals that I work on for my clients have at least a minimum of a 10% return on investment. Usually. Minimum. Okay? So, now we get into the avoiding the chase piece, which is the second part of my slide presentation. Avoiding the chase. Again, this is mortgages and with the way that the industry has changed so much, it is complicated. You have to provide so much data to do a loan. And the idea is to make sure that you're doing everything up front. So if you get with a good lender, a lender that understands this business frontwards and backwards, more importantly, understands investors. Investors, you got to talk the same language. You got to know the products. I primarily work with investors. My mortgage company, when I started this company, was specifically tailored to work with investors. Why? Because investors buy a lot of houses. And that means a lot of loans. And that means a lot of my money is going to help you guys become hopefully be able to retire with passive income. So, all of my money is poured into my organization. And I'm here to help you guys get the money that you need so that you can leverage. So what's the name of the game? You leverage the bank's money to buy the house, and then you leverage the renter's money to pay the note. So your initial investment is really all you're coming out of pocket with, and that's the name of the game. So get all your documentation up front. Make sure you're dealing with a good lender that knows exactly what you're going to need. Keep great records. For those of you guys, let me ask a question. How many in this room right now have at least one investment property? Okay. How many in this room have 4 investment properties? Does anyone have more than 4 investment properties? Okay? So you have to keep a good rent roll. Everybody understand what that means? Keeping a good rent roll is keeping track of your everything. You have a spreadsheet with the principal and interest, taxes and insurance, the mortgage, all the expenses. It makes it a heck of a lot easier when you send that information to me so I can put your deal together. When you give me that rent roll, I can look at that and say, okay, I got all the answers here that I need to put the deal together. So make sure that you guys are keeping great records, especially as you start to acquire more properties, which we'll get into. Deal with an expert in the field. Obviously, this is a plug for me, right? I mean, I'm a seasoned mortgage banker. I've been doing this now for about 12 years. I own my own mortgage company. I've owned net branches in the past, but as I said earlier, I tailor fit my organization to work with investors. So I'm a preferred vendor for Lifestyles Unlimited. I've been doing this for a long time. So if I don't know what I'm doing, or my team doesn't know, then we're in some serious trouble. So you get with myself, you get with my team, and they will help you making sure that you know exactly what you got to get up front. Working with an expert in investor loans is key, right? Make it your business. So all of you guys are here today because you guys are wanting to be investors, or you are investors, and you understand the strategies of the passive income, right? So make it your business. Truly understand what passive income can do for you. If we just saw those return on investments, I was talking to my pops yesterday about getting into this business because he wants to retire sooner than later, and he was telling me, I want to retire maybe in a couple of years, and I've been talking to him about trying to get into passive income. We spent about a good hour yesterday crunching numbers. And he's so excited to get into the investor game because he didn't realize how great it could actually be. So make it your business. Understand how it works, and I promise you you'll be successful with it. The product line. Traditional financing, that's what I do. I do traditional financing, which is your conventional products, Fannie Mae, Freddie Mac. This is what I do. Okay? And you have your hard money conversions, which is what, Chris will do the hard money, and then he'll send that client over to me to do the conversion piece. All that means is just a permanent loan, having the exit strategy to get out of that bridge loan that you're in so that you can get into a permanent loan. This is what we offer at AMP. Does anyone know what delayed financing is? This is a great product for investors. Show of hands. Anybody know what delayed financing is? Okay. I'm going to share with you what delayed financing is, and it's a great product. Let's say you got a deal that's just too good to pass up, and you don't have time to wait for an investor or a lender to do a loan. You don't have time really to wait for hard money either, although hard money's fast. And you want to buy this property outright cash. You have the money to just pay cash for the house, like tomorrow. You can pay cash for the house, and the very next day after you've closed, you can come to me and say, I want to pull that money right out, Rich. And then in 2 weeks, 3 weeks max, I'm able to get you your money that you paid for the house, barring that the LTVs and all that work. You're able to take the money, you're able to take out what you paid, what you acquired the property for, no repairs, it's just the acquisition, or 70% LTV, whichever is less. It's called delayed financing. It's a great product.
You have to be seasoned for 6 months.
No, that's the beauty of delayed financing.
Without cash out.
You do it for cash out. Now, here's a caveat. You got to be careful. If you bought the property cash and it took you 6 months to do the repairs or something, then you wanted to then pull the money out. So I paid cash for it, I want to use delayed financing. After 6 months, it's no longer delayed financing. It's a traditional cash out. And if you have more than 4 finance houses, what do you think I'm going to tell you when you say, hey, I want to pull cash out? I'll tell you, you can't. If you have more than 4 finance properties, you can never pull equity out of an investment property. You can take the money out of your primary. Primary home, you can pull cash out anytime. But you'll never be able to pull any equity out of an investment property if you have more than 4 finance, unless it's delayed financing. Unless you actually paid cash for the house, but you got to act within 6 months. Outside of 6 months, no bueno. About as much Spanish as I know. No Mexican. Go figure. Yes.
If you're doing a hard money
I know,
conversion,
man, tell me. It's a struggle. The struggle's real, man.
if you're doing a hard money conversion with a lender like us that does not have a prepayment penalty, how fast can you refi? Can you repeat the question?
He said basically, if we're doing a hard money conversion with a lender that does not have a prepayment penalty like Longhorn Investments, how quick can you refi? And the answer to that is 14 to 21 days. I make it my business to close fast because time is money. So 14, 21 day closes. From a purchase to a refi. We can make it happen quickly. Now you just have to be, you got to be motivated too. I mean, if I got a borrower that's not motivated and not getting me the things that I need, it's going to take longer. But if you got a motivated borrower that's on top of their documents, I can close fast. If you have a motivated realtor, I can close fast. You know, and you don't have to take my word for it. You can ask any of the people that I've worked with. They'll tell you how quick we can close. Yes.
Back on the delayed financing. So you said under 6 months, and I think that you said up to 70% of value. So if I can compress my rehab and
No.
get under that.
No.
No.
Only acquisition. You can only get out your acquisition or 70%, whichever is less.
But I can get out full cost of acquisition.
No, you can get full cost of acquisition plus closing cost, but you can't get your rehab money out of it. Again, 70% or acquisition plus cost, whichever is less.
And that is a traditional Fannie Mae loan.
Traditional Fannie Mae loan. It's a cash out refi, delayed financing is what its technical term is, delayed financing addendum. But it's a great product, yes. Are you talking about your primary residence? If you have more than 4 finance properties, you can never pull cash out of any of those properties that are investment homes. You can refinance them as rate term, but you can't pull cash out. No, you cannot. Refinancing is just a rate term, meaning that you can only pay the balance on the note. If you have more than 4 financed properties, the only time you can ever pull cash out is if it is your primary residence. Fannie Mae's hip to the game. They're not going to let you use your house as a debit card. You know, when you want to pull money, it's just not a reality. Unfortunately, should you be able to? Of course, I think you can. I think if you're responsible and you know how lending works, but Fannie Mae just doesn't allow it.
Well, I don't understand. So after 5 years as a lender, I have this 6 properties that I pay on 80% of my house. So I have a substantial equity in this property.
Yep.
How can I use my equity to purchase more properties?
You'd have to pay off one of those properties. So what I would do in that situation, let's say you had 6 and you got a substantial amount of equity in the properties. I would do a cash out refinance and try to pay off one of your other loans so that I can get you under 4. Because if you're over 4, you can't pull equity out of it. The idea would be to get rid of the note then so that the mortgage is gone and then to get you down to 4. So let's say you had all the properties, this is finance properties. Remember that, finance. If you got 10 homes that are free and clear, you can pull money out all day. But it's financed. If you have more than 4 financed, you You can never pull money out of an investment property.
I mean, of course, you're counting my primary income.
You are counting your primary into that. But you can have 10 finance homes, and you can always pull money out of your primary residence. Always. It's just the investment houses that you have to be careful. Yes?
Financed, is that Fannie Mae financed, or is that any?
That's a great question, and that's anything. It's a great question, but it's anything. It's anything that any money that's not yours. If it's private money, if it's hard money, it doesn't matter. Any money that's not yours that you have a loan on, it could be owner financed. If it's owner financed, it counts as a finance property. Now, Fannie Mae just threw a monkey wrench into the game, and I'm going to tell you guys what that is. It used to be that you did not have to count properties in an LLC as a part of financed homes, because some investors like to buy properties and then throw them in their LLC, and they technically think that they can kind of play the system that way, so it's not really owned by you as the individual, it's owned by the LLC, so it shouldn't be considered a part of the financed properties. Not anymore. As of August of this year, Fannie Mae said that if you own 25% more of that business, you have to count it as a financed property. You don't have to count it towards your ratios because the LLC owns it, but you have to count it as a financed property if it's financed. So that's something that just came out in August, so be careful of that because that might come back in.
Are the rates on the delayed financing, I mean,
Traditional cash out rates. It's just traditional type of, whatever's out there. I mean, it just varies. It depends on your credit score and your LTV. It can range from, 4.875 to 5.5. Just depends on your credit score and your LTV. Escrow holdback. It's another good product that we do, right? So let's say somebody mentioned earlier, what if they bought the house and they wanted to use their own money for rehab? This would be a good product for you to go straight conventional rather than going hard money. Because with escrow holdback, Fannie Mae says you can buy the house, and if it has, let's say, $10,000 worth of repairs that need to be done, and you want to put up your own money, the lender would let you put up your own money in an escrow account, fund the loan, and then pay the contractor out once the repairs are done, and you can go straight conventional. You don't have to go hard money if you didn't want to. You could go conventional in that standpoint. There's going to be a threshold there where you have to figure out what's the lender's comfortable level in terms of allowing it. If it's, I would say, more than $10,000, it's going to, more than likely the lender's not going to allow for the escrow holdback. But it's one that works really well where if you got a couple thousand, 5,000 in repairs or something, and it's just not worth it for you to go hard money, or you don't want to go hard money for whatever reason, then this would be a good product, is the escrow holdback. Okay? These are some other things that we do. We specialize in investor programs, hard money conversion, rapid acquisition, projected rent. Here's the beauty, and this is what I'm going to talk about here in this segment. Somebody asked me earlier how they calculate rental income. Fannie Mae actually allows you to use rental income on the subject property that you're buying. So let's say you come to me and you've been to 4 or 5 different lenders and they say they can't get you approved. My debt ratio just doesn't work. I can't get you approved for anything. But then you come to me and I say, well, if I use the rents that you're going to get on this property that you're buying at 75%, I can offset the payment and I can qualify. Fannie Mae says you can do that. People just don't know how to structure it correctly. Fannie Mae allows you to use, when you get your appraisal completed and you get a 1004 or a 1025 or 1007, which is basically a rent market schedule, tells you what the market rents are for that area. Fannie Mae lets you use 75% of that. Whether there's a lease on that house, whether it's vacant, they don't care. If you get an appraisal done with those schedules, it has market rents on it, they'll let you use 75%. So you can offset that payment. That's a Fannie Mae guide, but a lot of lenders have an overlay where they don't let you do that because it scares them. Fannie Mae says you can do it. So that's something that sets us apart and allows us to help investors buy properties all day because they can use that income. I did 3 fourplexes for a guy maybe 2 months ago. That was his entire source of income. He made $1,000 in Social Security. He had $200,000 in the bank, and he created $6,000 in passive income by buying 3 fourplexes. That was his retirement strategy. he couldn't get approved anywhere because everybody was saying, you only make $1,000 in Social Security. Wrong. I was able to use 75% of each of those properties, ran the loans simultaneously, and created income for him, and he qualified for 3 loans, and now he just, took his little investment, or not little, a substantial investment of money that he had, put him in 3 fourplexes, and now he has passive income for the rest of his life. $6,000 positive cash flow, plus the $1,000. Now he's making $6,000 a month, where he was only making $1,000 before, and nobody was able to qualify.
So the fourplexes were already rented and bought in that way?
You got it. They weren't. Well, even if they weren't, though, I would still be able to use the rental income and qualify. Even if it's vacant, absolutely. Even if it's vacant, I can still use it. Because I just get to get a 1007 or a 1025 appraisal, and I can get it done.
How about if it's like a subject to or buy it, but you know you can put a tenant in it, and you can rent out that property with whatever the actual market.
I'm always going to be able to use 75% of what the market rents are on that subject property. Always.
So that's where he got the money from, like say for instance, if it needed to be rehab, that fourplex, where would he get the money? If he's only getting $1,000 in Social Security?
Well, he had money put away. He had a nice little chunk of change.
Oh.
He had a little chunk of change that he had put away from just his, retirement, and he used that money to do the little rehab that needed to be done. But the catch to that is I was able to qualify him using the rents off of those properties. Because on paper, he made $1,000 a month, when most lenders were looking at him. But Fannie Mae doesn't see it that way if you package it well. So he comes to me, and Rich Nunez packages the file, and I just now took $1,000 a month and turned it into, now he's making $7,000 a month. Now he qualifies for these properties because the payments are offset by the rents coming in, and then it gave him positive income that got his ratios below 45%. And I closed 3 loans for him, 3 fourplexes simultaneously, so that I could use all of those income, all the income on those properties, and it worked. Yes.
When you calculate the 20% of the loan amount of the down payment, do you take the face value or do you take the
Purchase price. Purchase price. Acquisition cost. Purchase price.
But then if you want to take the cash back, it would be the face value.
If you're doing a cash out, it's appraised value. If you're doing a cash out outside of 6 months, it's appraised value. But remember, if you have more than 4 finance, you can. But if you're doing delayed financing, it's going to be acquisition or appraised value at 70%, whichever is less. So let's give you an example. Let's say you bought the house for $50,000 cash, but the house is worth $100,000. I couldn't do a loan for $70,000. I'd have to do a loan for $50,000 because that's what you bought the house for on a delayed financing. So it's whichever's less, 70% or acquisition, whichever's less. Somebody had their hands up.
Cash out refi, is it a 6-month seasoning period?
It is.
Before you can
Full cash.
do the appraised value?
Correct. That is correct.
What's the percentage on that?
What you can pull, 75%. 75%. Of course.
I'll be using the rental income. Let's say, for example, I have a debt to income ratio of 45%. I've got a property that I'm looking at buying. Use 75% of the rental income. It's $1,000 a month to make it $1,000. And then, chances are 75% of that is $750 a month, which is going to be about equal to
Your payment.
whatever my debt.
You got it.
I don't understand how that's not making my debt to income ratio higher. We just added $750 a month.
It makes it-
$750 a month in debt.
It makes it lower because it cancels out that payment. So you were just gonna, if you didn't use that income, you just basically added $750 to your debt ratio, right?
So it's not that you add $750 to your income on your overall picture, and $750 to your debt, and then recalculate. It's that those two cancel.
They can't.
And never.
Perfect. There you go. It cancels each other out and allows you, so whatever the ratio was prior to buying the house,
Gotcha.
it cancels it out. Make sense? And that's
So if I have 10 properties, it's not that all 10 of those properties
Schedule E. It's only if you had enough time to claim, okay? Hard money can usually lend up to 70 to 75% of after repair value, okay? Do a hard money conversion loan into a conventional loan, which is where I come in. Have a renter ready. The minute we're getting ready to close, have a renter ready so that I can use the rents on that property to offset. Because I can't do what we did. The only time I can use 75% is at acquisition. If you already bought it going hard money, you got to have a renter ready to go. I can use the lease agreement and a canceled check for a security deposit at 75%. And I'm probably going to need that if you have more than a few properties already financed. I'm probably going to need to use that income. That's the hard money strategy, more or less. The conventional method. Traditional down payments, obviously, 20% down is what you're going to be looking at. That's why you need the capital to be able to do it. Okay? You got to find a renter pretty quick. If you're doing the acquisition piece, again, I can use 75% of the rents received if you're acquiring it. But if you already acquired it a month ago and now you're going to go buy property number 2 within 2 months, that one that you bought a month ago, got to have a renter. Got to have them in there. Okay? You have the renter in there. You got to get your lease agreement. I got to get a copy of that lease agreement and security deposit. I get a copy of the lease agreement, security deposit. Don't accept cash or money order.
Make copies of the deposit or money order check.
Yes, if you're going that route. Yes. But you have to be super careful on how you document it, because if you don't document it well enough, I won't be able to use it. You know, how do you document cash? You can't document cash. So if you're going to do a money order, make sure you're making copies of that to prove that it came from the renter. Okay? Does everybody know what 6 months rent loss coverage is? That's basically, and this is important, because if you're rapidly acquiring properties and you're doing 10 homes in under 10 months, for 6 months rent loss, and if you're a new investor, rapid acquisition has 2 meanings in the lending world. It's got the meaning of what we're saying, rapidly acquired properties. That's the good meaning. It also has a very negative meaning for underwriters. They don't like it if you don't know how to package it. They're going to look at it and they're going to say, this person is rapidly acquiring properties and they got to continue to use the income on these properties that they haven't even got a renter in, or they just got a renter and they're not a seasoned investor. I'm scared. I don't like this. I don't want to prove it. And that happens a lot. This here helps offset that. When you get a homeowner's insurance policy and it comes with 6 months rent loss coverage, I can go back to the underwriter and say, yeah, you know what? Maybe this person isn't a seasoned investor yet. Maybe they have bought, 5 properties in the past 2 months. But if for some reason one of those renters is out of the property, or the house burns down, or something happens and the unexpected renter leaves, the insurance company is going to pay 6 months worth of payments. That makes them feel a little bit better that during that time frame they can find another renter. So 6 months rent loss coverage is crucial. You got to get it on every one of your rental properties. And if you don't, call your insurance agent and get it anyways, because you have to have it. You don't want to be in a position where you won't have, if something did happen, you want to make sure that you have, loss of use happens. Yes. So make sure that we talk about that. So 75% of rents received is obviously the equation when you're determining the actual rents you can use. Copies of the canceled checks, which we just talked about. Copy of the HUD and note. So let's say you bought a property a month ago, you got it leased, you got security deposit. I need a copy of the HUD and the note. These are all the things that I'm going to need so that I can offset the actual payment. Yes.
What if you're using a property management firm? Is their statements satisfactory?
Yeah, I'm sure we can paper trail it somehow if you're using them. We just have to find out what they get. Yeah, but yes, that comes up often. So copy the HUD and note, and then repeat, and repeat. And this is how you acquire properties. So here's the beauty, and I'll wrap it up because I know we gotta get going here. But when you do the 10 properties in under 10 months, you're able to maximize the income on those properties because you're using 75% of the rents received. So when you start the process to buy properties, you want to kind of buy them in a rapid fashion if you have the capital. Because then you can maximize the income that you're getting on those properties. Because I guarantee you when you file that tax return and that Schedule E, as much as I can sit here and tell you guys, don't claim all these just be careful with the deductions. I'm going to get that tax return and you wrote everything off under the sun, because that's just what people do. And then I can't use the income. I'm like, well, now we can't buy any more properties, or now we got to wait until next year. With the rapid acquisition philosophy, you can use 75%, and you can keep buying, and the capacity piece is covered. The payments are going to offset each other. And again, the rule is if you can afford 1, in terms of debt ratio, you can afford 10. You just got to have the capital. Does that make sense? Okay. So this is what I've done year to date with investor loans. Closed 312 loans, almost $43 million, where I've been with just investors like you. So I think, we know what we're doing at AMP. This is just a, it's a small, not a small piece, but it's a good piece of our business. But we do conventional lending for primary residents and all that stuff too. But investor loans year to date, we're at that calendar from September to September. Okay. This is all my contact info. If you need to reach me, I got cards in the back, but this is my contact info here. If you need to reach me or my organization, I'm off of Breaker and Mopac. Yes. I don't do commercial and I don't do land. I am not a jack of all trades. I'm a master of one, and that is the investor loans.
If you're an Austin, should we work with you or should we work with like Rick Stiegel?
Rick Stiegel's out of my Katy office. He's one of my loan officers. But if you're in Austin, I would say you call one of my guys here in Austin. Or you can work with Rick too if you already have a relationship with him. He's one of my LOs. I have 2 offices. One in Katy, he's an LO there, and then I have LOs here. And then I also originate too. I do, I don't know, 5 to 10 loans a month myself. Just if I have one that falls in my lap, or I have a client that's going to be a little bit more complicated, I work with those. I do some deals myself, but primarily anyone on the staff can help. We got 25 plus loan officers that can help with whatever you need. Yep. But so you work with Rick?
Yes, I do.
Okay, great. Yeah, Rick, work with Rick all day. Absolutely. Don't change that. Does somebody else have a question?
San Antonio, that's it?
San Antonio. Well, we don't have an office in San Antonio yet, but we can do loans anywhere in Texas. So call me. I'll get you, either I'll do the deal or I'll send you to the 2 guys right behind you. Those 2 are my guys there too. They're 2 of my guys, and I got a great staff of people, and they all know how to do these transactions too, or if they don't, then we're in trouble, right? So that is it, folks. Does anyone have any questions that they have for me at this time? No questions? Did I go over everything? Was everything pretty informative? You guys learned a lot there? Yeah, some good stuff?
Thank you.
Awesome. Okay, well, look, I appreciate you guys coming out, spending time with me and Chris, and I know Andy's got some things he's going to go over with you guys. But if you guys need anything on the conventional side, any type of advice on investor loans, AMP Lending's here to help. Hopefully, rapid acquisition will be done in a couple of months, and then I'll be able to market that and get you guys some copies of that book. Okay? Cool. Thanks, guys.